Hello, and welcome to this webinar from the Business and Local Government Data Research Centre with Mingchen Sun from the University of Essex. In this webinar, Mingchen from the Business School will be speaking about his recent research on bank lending conditions. Mingchen will speak for about 30 minutes. He will then address any questions that you might have at the end of his presentation. You can submit your questions at any time throughout the session via the questions box in the panel on your right. So I'll pass you straight over to Mingchen and we can get started.
Hello everyone. Thank you for the introduction, and I'm honored to be here to give a presentation of our research. And today I'm going to talk about the bank lending conditions in the small and medium-sized enterprises, that is SMEs, play a very important role in almost every country. Mainly because they are drivers to the job creation and the local economic growth. In the UK, of all private sector enterprises, and just during the period from 2011 to 2016, the number of the SMEs increased by about 20% to 5.5 billion in 2016. And they also contribute almost 60% of the employment and 47% of the annual turnovers. SMEs rely heavily on bank debt as external financing sources, and they are more likely to face credit constraints relatively to large firms. One of the main reasons is they are often startups and young firms, which may not provide sufficient collateral, and in this case, the banks will think the SMEs are riskier than the large firms. And typically, SMEs also have limited net wealth, and they are less informationally transparent, have lower formal reporting needs, and less external monitoring than the large firms. Such reasons make banks more cautious in their lending to small business compared with lending to large firms. On the supply side, banks' financial conditions and the lending capacity have been significantly affected by the global crisis. SMEs suffered from tight credit market conditions, and today the UK SMEs, like many other European SMEs, are still struggling to find adequate funding to survive, invest, and grow. To allocate the difficulties faced by SMEs in finding bank credit, the UK government launched several schemes in an effort to facilitate formal lending for SMEs, such as the Funding for Lending scheme in 2012. However, the slow economic recovery in the wake of the global financial crisis and June 2016's referendum results on Brexit have again increased risk and instability for business of all sizes and sectors. Among the key concerns are the prospect of leaving the European single market and the uncertainty surrounding the regulatory environment, as the UK will have to convert and adapt EU legislation. In the worst case scenario for Britain after Brexit, all businesses will suffer from shortage of labor, trade restrictions, and tariffs that will hinder their profitability and growth opportunities, possibly leading to even higher default rates. So credit may become even harder to get for small, riskier business. And in our study, we aim to provide an up-to-date evaluation of the UK bank credit conditions. And we try to look at the problems of the debt rejections for the UK SMEs in the wake of the financial crisis, and also including the period of great uncertainty in the run-up to the Brexit referendum in 2016. And we also try to offer an in-depth investigation to analyze whether the trends in the lending conditions differ by firm size and firm age. Here, I try to show some selected previous literature, and in the Fisher study, he thinks the earlier years from 2001 to 2004 to be the normal time of the lending condition, And relatively to these earlier years, the SMEs in the UK market experienced a boom in the availability in the next 3 years, but they have to face a higher probability of rejection and also higher costs in 2007 to 2009. Colin et al. In 2012 used some survey data to perform the analysis, and they used the wave of the survey as the time indicator. And finally, they find just during the period and the financial crisis, the applications in the April and also September in 2009 are more likely to be rejected. The restriction is found to be ongoing up to 2012, and it seems to persist into 2013. The data in our study is from the SME Finance Monitor, which provides a micro firm level survey data from 2011 to 2016. And here we use Q1, Q2. It's because the first wave of the survey is conducted from February to May in 2011, but from the July in 2011 to the end of 2015, it is conducted in a standard quarter. And at the beginning of the 2016, the frequency of the survey has changed to twice a year. And that's why we put an S to denote the semi-annually before the 2016. In each wave of the survey, around 5,000 telephone interviews will be given to different SMEs in the UK. So the data structure is just a repeated measure. It is not a panel structure. And from the data set, we can have some information about the experience of seeking and obtaining external finance in the previous 12 months of this SME. And we can also know some characteristics of the firms and also the owners. Although SME is a widely accepted concept, but different authorities, different organizations, and different studies use the different definitions for SMEs. And here we just use the same definition as the one in the data set. Here, that is to say, a firm is defined to be an SME if it has no more than 250 employees and no more than 25 million pounds annual turnover. Limit of the annual turnover is slightly lower than the limit given by the European Commission, which is the 50 million euro. And it has also to be qualified to satisfy the two qualitative criterion. That is, no more than 50% of the firm should be owned by another company, and this company should also be run as a social enterprise or a non-profit organization. In our research, we treat overdrafts and loans separately, mainly because the firms apply for these two kinds of facilities for different reasons. And here we show the reasons for the applications. And to notice here is the firm can choose more than one answer. That's why the exam is more than one. And we can see that for the overdraft applications, the firms mainly to use the overdraft as a working capital or as a safety net just in case. But for the loans, the firms apply for loans to fund the expansion of the business or to buy some fixed effects and premises. So that is to say the overdrafts are mainly used as a facility to help with the day-to-day cash flow, while the loans are mainly used for the growth of the firm. And here we show some trends in the data. In the figure of the left-hand side, we show the trends of the number of applications during the period we are focusing. And we can see that for the overdrafts, the number of applications is almost twice as the number of the loans in all years. We think that is attributed to the higher needs for the working capital. And it also reveals a dramatic drop in number of applications over 2011 to 2015 for both overdrafts and loans. Although the number of applications cannot measure the credit demand accurately, but we still think this trend is suggestive of a decreasing credit demand in the wake of the financial crisis. And in the figure on the right-hand side, we show the trends in the rejection rate during the period. And the rejection is defined in the case that the firm is either refused outright or receives less credit than they request. And we can see that the rejection rate is higher for the loans than the overdrafts in every year. This reflects the preference of banks to issue short-term finance. And we can also find that for both overdrafts and loans, the rejection rates appear higher in 2010 to 2014 compared to the more recent years. The trend implies a tight credit condition until 2014, and then the condition seems to become better in the most recent years. The rejection is used as a dependent variable in our regression, and here we just show all the independent variables we try to employ in the model. The application date is the interest of main interest, and it gives the exact year when the firm applied for the debt. And we also include firm's characteristics, owner-manager characteristics, financial relationship, and some variables related to the application process. For the firm's characteristics, we include some demography, some profitability, the business activities, like the business plan, the internalization, and the innovation. And we also use the credit balance as the proxy for the financial security. And we also use the external risk rating from the DNB as the proxy for the credit risk of this firm. As for the owner characteristics, we include the gender, the age, and also the financial knowledge. And the bank relationships, we use the number of finance providers as the proxy for the financial concentration. Since the length of the relationship is unavailable in the dataset, we only consider whether the firm made its application to the main bank or not. And we also include the use of credit card. Besides, we also add some variables related to the application process, such as whether the firm seek advice before the application, whether the main account used for the business is a business account or a personal account, and also the amount of the amount of debt the firm applied for. However, one thing that's worth noting is what we use is the survey data. So there might be some missing values in the dataset. And if we remove the observations with missing values of any independent variable, we will remove 40% of the overdrafts and 45% for the loans. This might bring bias and inefficiency to our study, so we have to do something to deal with the missing values. The dependent variable is rejected or not, so it's a binary variable, and we apply the logit model. And just as mentioned here, we use the widely known multiple imputation to deal with the missing values. And specifically, we apply the fully conditional specification implemented by the chain equations algorithm to impute the missing values. And we use the mice package in R to perform the imputation and also the analysis. And as I show in the previous slides, we include lots of independent variables. And in order to avoid the noise brought by the unnecessary independent variable, we apply some selection techniques here. The one we apply is based on the recommendation of Wood in 2008, and it is the backward stepwise selection approach based on the Rubin's rule. So in the tables I will show in the following slides, there might be some blanks in the table, and it just means that that dummy variable is insignificant and removed after the selection technique. And then is the empirical results. In this model, we only incorporate the application date as the independent variable. And after the selection technique, we can find that for overdrafts, applications in 2012 are more likely to be rejected, and applications during 2014 to 2016 are less likely to be rejected. And for the loans, firms applied in 2011 to 2013 are more likely to be rejected. That suggests that the firms are experienced a very tight condition just after the financial crisis. And the applications in 2015 for the loans are found to be less likely to be rejected, but only in that particular year. Then we add all the independent variables shown in the variable list into the model. And after adding the control variables, we just find very small changes for the overdrafts. But we found for the loans that the applications in 2011 to 2013 becomes insignificant. That means the higher probability of rejection during these 3 years should be attributed to the risky profiles of the applicants rather than the tightness of the loan market. And for the loans, we find the applications in 2014-2015 are less likely to be rejected, suggesting the lending conditions for the loans becomes better in that 2 years. But again, we find the condition becomes back tight as the previous years in 2016. This might be relevant to the uncertainty brought by the Brexit referendum. As for other independent variables, we do find some similar determinants for overdrafts and loans. First, we find that bigger and older SMEs are less likely to be rejected. This reveals an expected negative effect of size and business age. The size effect seems to be stronger in the loan applications, while the age effect seems to be more relevant in the case of the overdraft applicants. And we also find that partnerships play a very important role in reducing the rejection rate. This might be relevant to the lower default rate of partnership, which has been found by previous studies. We also find the firms that are profitable or running on a break-even basis are less likely to experience rejections. And also, innovative SMEs are more likely to be rejected. One possible explanation is the innovation is essentially a speculative process, and banks are unwilling to bear the accompanying uncertainty. The external reason from DNB shows that the riskier the SME is, the less likely its application will be approved. We also find that a lower likelihood of rejection the firms with larger amount of credit balance. This result is, for me, this result is expected as the firms with higher credit balance are less likely to default, and even in some tough times, they are also more capable to survive. As for the gender of the owners, we find that the firms with female owners or female managers are less likely to be rejected. This is kind of different from the previous claim that the male entrepreneurs will perform better than the female entrepreneurs, and so the banks might be more likely to issue the credit to the female, to the male entrepreneurs, and the finding here is kind of different from that one, and we think the possible reason is the risk-averse attitude of the female managers. This attitude will make them to select some conservative projects or the low-risk business plans. And then the banks will think it is better to issue credit to the female. Except for the similar determinants, we also find some different determinants for overdrafts and loans. The remarkable differences appear when we look at the effects of the variables related to the application process. We can see that such variables are all highly significant for the overdraft applications, but always insignificant for loan applications. Specifically, we find firms using business accounts appear to have a better access to overdrafts, possibly because the banks can monitor these firms' behavior more closely by using the business account. And we also find that applications for the higher amounts tend to be more likely to be approved. This is possibly relevant to the higher monitoring costs and lower profit margins brought by the smaller amounts. However, surprisingly, we find the firms seeking advice before the applications are more likely to be rejected. One possible explanation is firms seeking advice are risky firms which think they will fail or encounter difficulties during the application process. So in the UK market, we find that size and age do matter when it comes to applying for traditional bank debt. And here we carry out additional tests to check how much size and age matter by using the different subsamples. First, we focus on the size and split the full sample into 3 subsamples according to the number of employees and the amount of annual turnovers of the firm. We call it micro, small, and medium-sized. We try to match the limit with the limit given by the European Commission. And here we can find for the micro firms, the applications in the most 3 years are less likely to be rejected for the overdrafts. While for the loans, we find that for micro firms, the applications in 2013 are likely to be rejected, and applications in 2015 are less likely to be rejected. However, we can see that for both overdrafts and loans, there seems to be no difference between the applications in different years for small and medium-sized enterprises. This implies that the recent government schemes designed to stimulate bank lending to SMEs seem to be significantly more effective on micro firms compared to small and medium-sized firms. And then we split up to the startups, to the young firms, and mature firms. For the overdrafts, we can see that in 2012 and 2013, the applications for startups are more likely to be rejected, while for the young firms and mature firms, the tighter conditions do not appear. And for the loans, we also find that applications in 2012 and 2013 for startups are more likely to be rejected. And again, this do not appear for the young firms and the mature firms. And we even find that in 2015, the young firms and mature firms are experiencing a better condition, while for the startups, the condition is still as tight as that one in the 2010-2011. So we would like to say that in some years, the startups have to face worsened conditions, while young firms and mature firms do not. And here I show what we do for the robustness check. As I mentioned before in the previous slides, the first wave of the survey was conducted in a non-standard quarter, and the frequency of the survey has changed at the beginning of 2016. So we try to see that whether the frequency change of the survey data has some impact on our results. So we exclude observations in these 2 years, and the results stay the same. We also try to use another definition of the dependent variables. We try to construct the dependent variable in an ordinal way. Let it equal to 0 if the application of the firm is approved, equals 1 if the firm received less than it requested, and equals 2 if the firm is rejected totally. And as the dependent variable is an ordinal variable, we employ the ordered logic model, and the results stay the same. We also find the cutoff points between 1 and 0 are highly insignificant. This suggests that there is no need to separate them, and we can combine them together, and the binary variable of dependent variable is a proper one in our regression. And finally, we also perform the robustness check concerning the sample selection issues. By definition, the rejection can only be observed if the firm actually applies for finance. It has been claimed that the application decisions are not random, and there might be some sample selection bias if the firms which do not apply are removed from the analysis. So here we employ the profit model with sample selection to test the possibility of the selection bias in our sample. In this model, we have two equations. One is the selection equation, and the other one is the outcome equation. The dependent variable in the selection equation is whether a firm applies for bank debt, and the dependent variable in the outcome equation is whether the application is rejected. For both overdrafts and loans, we use the import as a selection criteria. Since we find that this variable is significant in the selection equation, but insignificant in the outcome equation. So that means this variable is related to the application decision making, but it is unrelated to the bank decision making. So we use this instrument for the identifications. The final results show that the correlation coefficient between the error term of these two equations is insignificant for both overdrafts and loans, indicating that there is no selection bias in our sample. So in conclusion, we find that overdraft and loan markets show different trends, but we also find some similar determinants of the rejection rate. And we also find that relative to small and medium-sized firms, the changes in the availability for the micro firms are relatively consistent with the changes for the full sample, suggesting the potential effectiveness of the schemes on the micro firms. And finally, we show that for both overdrafts and loans, in some particular years, the startups face worsened conditions, while the young and mature firms do not have to, suggesting we had better pay a particular attention and provide some additional help to the startups. And that's all. Thank you so much for your listening.
Brilliant. Thank you very much, Mingchen. If anyone has any questions, then please submit them using the questions box on your right. Just to let you know that we will put a copy of Mingchen's slides up on the website so that you can access those after the webinar, and we will also put up a link to the full paper that Mingchen's written on this area. So I'll just start with this first question. So the question is, in the years where startups faced greater risk of rejection for their application, is this representative of a tightening of the lender's approval policy, or is it just as likely that the strength of the application from startups in those years were perhaps just weaker? An example of that could be that people are forced out of work in the weaker economy and have set up startups, thus lowering the quality of the overall applications.
I'm so sorry that the Wi-Fi seems not good, and I only hear part of the questions. Sorry. So
Okay.
can you please start?
Sure. So I'll start again. So the question is, in the years where startups faced a greater risk of rejection for their applications, do you think this is representative of a tightening of the lender's approval policy, or perhaps is it just as likely that the strength of the application from startup in those years was just a weaker application?
In my opinion, I think it is the latter one. I think it is just represents the startups faced tightened conditions. Well, but I think it still needs some more research on it, and I think we have to maybe to collect some data on these kind of things.
Okay, thank you. And we have another question asking whether there was any indication of ethnicity in the data that you used.
Ethnicity. To be honest, the data set have some data on the ethnicity, but this kind of data are not available from the first wave to the last wave. So it is not a general information. So we don't include it in our regression. But I have actually seen some paper and their results show that they focus on two research questions. The first research question is whether there is ethnic discrimination in the lending market, and the second question they are looking at is the perception of the firms. And their final results show that there is no ethnic discrimination. That means that the firms with owners from different kinds of ethnicity can obtain the loans equally, but they find that maybe the minority ethnic perceives that they will be rejected if they applied. So it indicates some misperception of the entrepreneurs, but actually there is no discrimination in the market.
Okay, brilliant, thank you. So if anyone's got any more questions they would like to submit, we'll just give people a little bit of time to submit those. Okay, so we've got another question asking from somebody who is intrigued by the gender factor in the analysis of rejection, and they're wondering what can SMEs with a disadvantaged gender bias do to overcome that bias?
Sorry.
I'll read it out again. The question is, what can SMEs with a disadvantaged gender bias do to overcome that?
Due to the
So they're interested in the gender factor that you spoke about in your analysis, and whether there's anything that they might be able to do to overcome that bias.
I think that to be honest, the previous studies do not have do not have the same conclusion on this effect. Some studies find that the firms with the male entrepreneurs are more likely to be approved, And other studies find that female owners are more likely to be rejected. And in my opinion, I think if these firms just want to get rid of this kind of bias, they can just have a closer relationship with the banks to try to give some signals of their creditworthiness of their firms, since the banks will make decisions mainly based on the probability of the default of the firms. So if the firms could convert some soft information and also some hard information to the banks that they will repay and will not default, I think this bias could be eliminated from somewhat.
Okay, brilliant. Thank you very much. So as I say, we will put the slides from Mingchen's presentation onto the website, and we will also link back to the papers that he's done that relate to these areas. So we'll just give people a few more seconds to submit any questions in case there's any coming in.
Yeah.
Okay, well, I think maybe what we'll do is we'll leave it there for the moment. Mingchen has very kindly shared his email address with you. So if there's any questions that you would like to, or any other information that you'd like to speak to Mingchen about, is best just to email him, and then he can hopefully answer your queries.
Yeah. Any comments, any questions, and are very welcome.
Okay. Oh, hang on. We've just got one more question in, which is saying that startups are always difficult. So, is there anything new in the findings that you found from your work?
Sorry, I only heard the last part of the question. What kind of other findings?
So the question was that startups are always difficult.
Yeah.
So what did you find out that was new?
Actually, what I'm currently doing is something on the equity crowdfunding. I think that could be another way to finance the startups, especially for the innovative startups. The innovation of a firm is kind of the people in other industries. It is hard for people in other industries to understand the process of innovation, and that's one of the reasons why this kind of firms are more likely to be rejected when they apply for the bank debt. And in the crowdfunding, especially, I think currently in the UK there are 3 very big equity crowdfunding platforms: the Crowdcube, the Seeders, and the Syndicate Room. And in the Syndicate Room, the equity crowdfunding has to involve a business angel that will give some due intelligence before the campaign. So the due intelligence of the business angel can give the crowd some signals that this company, this startup, is a pretty good one, and it has a profitable business plan, and then it can attract lots of attention and lots of money from the crowd. So I think it also depends on the purpose of your funding, on the purpose of your financing. But equity crowdfunding might be a pretty good alternative, especially in the UK market. And also, as far as I know, that the limit of the funding with no prospects in the platform has raised from 5 million to 8 million. So that means the firms can raise much more money on the platform with no burden on some administrative issues. So I think it might be a pretty good choice.
Okay, brilliant. Thank you very much, Mingchen, for your presentation and for sharing all of your research with us. Thank you everybody else for listening. We'll pop the slides up online, and there will also be a recording of the webinar that will include the questions. So if you want to revisit those, you can. So it just leaves me to say thank you very much to Mingchen, and we hope to see you soon.
Thank you very much.